Mercedes-Benz just posted its worst profit collapse in over a decade. Adjusted earnings down 40%. Sales are falling in China, the market that used to buy status by the shipload. That shouldn't be possible for the company that invented the automobile, the brand that spent 100 years selling the best or nothing. But it is possible because Mercedes did this to itself, on purpose, twice. First, by lowering its own standards to chase volume it never wanted to. Then, when that plan blew up in its face, by swinging so hard in the opposite direction that it nearly broke the company again. This is the story of how a name built on an obsession with quality decided deliberately that quality was negotiable, what that decision actually cost, and why the fix turned out to be almost as damaging as the mistake. By the end, you'll understand why a company that spent a century proving it never had to compromise is still, right now, trying to figure out which version of itself it actually wants to be. To understand how strange this is, you need to understand what Mercedes-Benz used to be. For most of the 20th century, the three-pointed star wasn't a status symbol first. It was an engineering standard. The company's own slogan, translated loosely, was the best or nothing. Not the best value, not the best design, just the best full stop, with no compromise attached. That wasn't marketing talk. Mercedes built cars in the 1970s and 1980s, like the W123 sedan, that routinely ran past 300,000 miles on basic maintenance. Taxi fleets across Europe and West Africa still run on 30 and 40-year-old Mercedes diesels today because the cars simply refused to die. Bodies were galvanized when almost nobody galvanized bodies. Panel gaps were held to a standard other manufacturers didn't bother matching. Engineers routinely overbuilt components customers would never notice, because the culture inside the company treated durability as identity, not as a feature to advertise. That reputation had a side effect: exclusivity. Mercedes made relatively few models, and every one of them was expensive. If you wanted the badge, you paid the price of the engineering behind it. There was no cheap way in. Some of that engineering was decades ahead of the rest of the industry by design. Mercedes patented the modern crumple zone concept back in the 1950s, well before regulators required anything like it, and safety features that debuted on the flagship S-Class routinely trickled down to lower models years later. Not because customers asked for them, but because engineers refused to sell a car they considered unfinished. That habit is expensive. It is also exactly what built the reputation in the first place. For decades, that was the entire business. Build the best cars in the world, sell them to people who can afford the best cars in the world, and let the rest of the market go to someone else. But a car company that only sells to the wealthy has a ceiling. And by the mid-1990s, Mercedes was starting to hit it. By 1993, Mercedes' board was watching two things happen at once. BMW was growing faster by selling smaller, more affordable models further down the market. And a brand new Japanese arrival, Lexus, had spent just a few years proving that affordable luxury wasn't a contradiction. It was a business model. Mercedes had never built a genuinely small, genuinely cheap car in its history. So the board made a decision that would have been unthinkable a generation earlier. It approved a compact car, smaller and cheaper than anything wearing the star before it, aimed squarely at first-time buyers and younger customers who had never been able to afford one. Internally, it was framed as an entry point for a new generation of owners. Keep that phrase in mind, it matters later. The car was called the A-Class, and the engineering behind it was genuinely inventive. To fit Mercedes-grade safety into a small footprint, engineers designed a raised sandwich floor that would let the engine slide underneath the cabin in a serious frontal impact instead of into the passenger's legs. On paper, it was one of the cleverest small car packaging solutions of the decade. If you're new here, this channel spends its time on exactly this kind of story. The moment a company quietly makes a decision that looks small at the time and ends up defining everything that happens to it afterwards. Subscribe if you want more of these, because Mercedes' next decision is where things start to go wrong. The A-Class launched in 1997 to genuinely strong reviews. Journalists praised the interior space, the safety thinking, the sheer engineering ambition packed into something so small. For about 6 weeks it looked like Mercedes had cracked the mass market without giving up anything at all. On October 21, 1997, a Swedish motoring magazine called Teknikens Värld put the new A-Class through a routine handling test, an evasive swerve maneuver drivers use in Scandinavia to avoid hitting a moose in the road. Journalists there had run the same test on hundreds of cars. This time, the A-Class rolled onto its side at 37 miles per hour. Mercedes' first instinct was to deny there was a problem. That response alone tells you something had already shifted inside the company. The old Mercedes, the one built entirely around engineering credibility, would have owned a flaw like this instantly. Instead, the company hesitated, and the hesitation let the story spread across European television before Mercedes said a word. The detail that made it humiliating rather than just embarrassing was what happened right after. A Trabant, the cheap, widely mocked East German runabout that had become a punchline across Western Europe, ran the identical test moments later and stayed upright. Within days, other outlets repeated the Mercedes test and got the same result. Sales of a car that had just launched to rave reviews were suspended entirely. 2,500 units already sold had to be recalled. 17,000 more were pulled in for retrofits. The car that was supposed to prove Mercedes could build a great small car instead proved, on live television, that it couldn't yet. But the moose test itself wasn't really the disease. A high centre of gravity and soft tyres are an engineering problem, and engineering problems get solved. What the moose test actually revealed was something else. That in its rush to build a car for a market it had never served before, at a price it had never charged before, Mercedes had let its own quality bar slip for the first time anyone could remember. And the fix for that was about to cost the company a lot more than one recall. The immediate repair was expensive and thorough. Mercedes halted A-Class production for 3 months, stiffened the suspension, and, critically, made electronic stability control standard equipment, a technology that until then had been reserved for the flagship S-Class. The total bill for fixing the car ran past $300 million. Supplier Bosch, which built the stability system, would go on to ship over 300 million units of it worldwide, largely on the back of the credibility crisis this one car created. That crisis should have been a wake-up call about moving carefully into new markets. Instead, 7 months later, Mercedes made a decision that pointed in the opposite direction entirely. On May 7, 1998, Daimler-Benz announced a $36 billion merger with Chrysler, the American maker of Jeeps, minivans, and mass-market sedans. Chairman Jürgen Schrempp called it a merger of equals. The stated logic was simple. Combine two manufacturers with almost no product overlap, share the cost of parts and platforms across both brands, and use Chrysler's lean, high-volume manufacturing discipline to make Mercedes' own factories more efficient. On paper, it was smart. Chrysler earned more profit per vehicle than almost any other American automaker at the time. Sharing components across a combined 4.4 million vehicles a year, instead of Mercedes' roughly 500,000, promised savings nobody in Stuttgart could ignore. When the new Daimler Chrysler stock began trading that November, it climbed above $108 a share within months, and for a brief period, the deal looked like exactly the industrial masterstroke Schrempp had promised investors. What that plan actually required in practice was Mercedes engineers sitting across a table from Chrysler engineers and asking a question the company had never had to ask before. Which of our parts can we make cheaper? That question produced a story people inside both companies still tell. When Chrysler engineers reviewed the cost of a Mercedes E-Class seat, they flagged it as wildly overpriced next to their own, and suggested Mercedes just use Chrysler parts instead. Mercedes' team was stunned by the comparison, so their benchmarking division bought a Chrysler 300M seat and took it apart to see for themselves. What they found reportedly horrified them. But cost pressure doesn't run in one direction for long. Over the next several years, Mercedes' own component costs across multiple model lines got pushed steadily downward, chasing the profit margins Chrysler's cheaper manufacturing had made look normal. Meanwhile, the merger of equals framing collapsed just as fast as the seat story suggests it should have. Schrempp himself later admitted in an interview that Daimler had always intended to run the show, a comment blunt enough to trigger a lawsuit from Chrysler investor Kurt Kerkorian, who felt shareholders had been misled about who was really in control. The friction wasn't only financial. German and American teams argued over basics, like whether a meeting had actually produced a binding decision or just a friendly conversation, and those small culture clashes slowed down the very efficiency gains the merger was supposed to deliver. While executives fought over who owned the company, the car business kept expanding downward anyway. The B-Class arrived. Compact SUVs multiplied. Mercedes now had more entry-level nameplates than at any point in its history, all of them under pressure to hit cost targets that had nothing to do with how Mercedes used to build cars. Somewhere in that expansion, quality control simply couldn't keep up with how fast the lineup was growing. And the people who measure that kind of thing for a living were about to notice. By the early 2000s, independent quality data started catching up with the internal cost-cutting. Consumer Reports and J.D. Power both flagged a wave of new Mercedes models, including the flagship S-Class, for electronics failures, air suspension problems, and interior components that felt cheaper than the price tag suggested. The redesigned S-Class launched in 1998, packed in more onboard electronics than any Mercedes before it, and that complexity became the source of years of complaints, including a suspension system prone to expensive failures and dashboard displays that simply stopped responding. Owners who'd bought Mercedes specifically because it was supposed to be bulletproof were suddenly dealing with cars that didn't work reliably. Then, in 2005, Mercedes-Benz posted its first quarterly loss in 10 years. Analysts pointed to two things happening at once: rising costs from the Chrysler merger and mounting concern over exactly the quality slippage the reliability data had already flagged. For a brand whose entire value proposition rested on being the one car that never let you down, a financial loss driven partly by its own quality problems was close to an identity crisis. The irony was hard to miss. Mercedes had entered the Daimler-Chrysler merger to fund its expansion into new markets. 9 years later, that expansion had helped drag down the very quality reputation that made a Mercedes worth paying extra for in the first place. Shareholders who had watched the stock slide for years were no longer willing to treat Chrysler as a temporary headache. Executives in Stuttgart finally started asking, openly this time, whether keeping Chrysler was worth it at all. That question had an answer coming, but getting to it wouldn't undo what 9 years of cost pressure had already done to how the world saw a Mercedes-Benz. In May 2007, Daimler sold Chrysler to private equity firm Cerberus Capital for roughly $7.4 billion, a fraction of what the American company had been worth just a decade earlier. The merger of equals that began with a $36 billion handshake ended with Daimler essentially paying to walk away. Without Chrysler dragging on results, Daimler's profits recovered fast, with Mercedes-Benz cars posting a healthy fourth quarter almost immediately after the split. You'd expect the story to end there, with Mercedes learning its lesson and rebuilding around quality again. For a few years, that's roughly what happened. By 2010, J.D. Power had Mercedes rank third among every nameplate on sale in America, up from sixth the year before, and the brand's own service satisfaction scores led the entire premium segment in Germany. The recovery was real. But the instinct that caused the original problem, chase volume, chase younger buyers, chase market share, which Mercedes had never bothered with before, never actually went away. It just went quiet for a while, then found new outlets, bigger touchscreens, more badge variants, cheaper interior trim hidden behind flashier ambient lighting, and an expanding lineup of compact crossovers built to hit price points rather than standards. Each one individually looked like a minor styling choice. Together they were the same 1990s bet, made again in smaller pieces that were harder to notice. By November 2022, Consumer Reports ranked Mercedes-Benz dead last among 24 major automakers for predicted reliability, worse than Chevrolet, worse than Jeep, worse even than Tesla. 25 years after a Swedish journalist tipped an A-Class over on live television, Mercedes had managed something that felt almost symbolic. It had gone from the industry's gold standard to its punchline. And the company's answer to that problem was about to make things stranger, not simpler. The pivot actually started in 2020, when Källenius first signalled Mercedes would cut fixed costs by more than 20% and lean harder into its sub-brands. By 2022, that idea hardened into a full reversal. Källenius announced Mercedes would stop competing for volume entirely. Entry-level models would shrink from 7 to 4. Investment would pour into Maybach, AMG, the G-Class, and a new ultra-exclusive line called Mythos, reserved for collectible six-figure cars sold to a handful of buyers at a time. The goal, in Kalenius's own words, was to build the world's most desirable cars. For a moment it worked. Fewer cars sold at higher prices pushed operating margin to 16.4% in 2022. Then it started slipping, 12.6% in 2023, just 4.8% by the third quarter of 2024, adjusted profit down roughly 40% in 2025. China, once Mercedes' biggest growth story, fell nearly a fifth in a single year. Chinese rivals like BYD and Xiaomi had closed the technology gap while charging far less. Mercedes' ultra-luxury EQS barely sold there at all. New US tariffs squeezed margins further. By August 2025, Kalenius was publicly distancing himself from his own strategy, telling reporters Mercedes had never really called it a luxury strategy at all. Behind the scenes, the company was already doing the opposite of what it had promised 3 years earlier, planning dozens of new models across every price point at once, hoping something in the pile would work. The company that lowered its own standards to chase volume had just spent 3 years raising them to escape the consequences. That didn't work either. So what actually went wrong? It comes down to 3 mistakes. First, Mercedes expanded into a market it had never served. First-time buyers, cheap compacts, before its quality control could scale to match. The Moose test wasn't bad luck. It was the first visible crack in a company moving faster than its own standards could keep up with. Second, to pay for that expansion, Mercedes tied itself to Chrysler and let cost-cutting instincts, born from comparing a Mercedes seat to a Chrysler one, spread across its own product line. That single decision quietly rewrote what Mercedes quality meant for the next 2 decades. Third, once the damage was undeniable, the company never picked a lane. It swung from mass-market compacts to ultra-luxury exclusivity and back again, sometimes within a few years of itself. Remember that phrase from 1997, an entry point for a new generation. In 2022, Kalenius used almost the identical idea in reverse, promising the world's most desirable cars instead of the most accessible ones. By 2025, he was already backing away from that too, reviving the A-Class for a planned 2027 return. That's the real economics of mass luxury. It isn't a pricing strategy. It's a choice between selling scarcity and selling scale, and refusing to make that choice at all is its own kind of decision, one with its own bill attached. Mercedes-Benz still has more engineering credibility than almost any car company alive, built up over a century, something most of its competitors can't match. Whether it spends the next decade protecting that, or spending it down one more time chasing whichever strategy looks most urgent this year, is the only question that actually matters now.